Well, hello everyone. It is the 26th of April, 2024. I am Delbridge, Benchmark Realty, Murfreesboro, Tennessee, and this is your weekly status chat. So let's just not waste time and get right to it. If you like this content, please go to CallDelToSell.com, find the tab that says on YouTube, click it, and it'll open up a page of QR codes. There you can use a smartphone to scan and get to the YouTube page, or you can just mouse over and click it on a PC. There you'll be able to subscribe to this little button over here and click the notification bell so that YouTube will notify you when each Friday's blog has been uploaded. Thank you. Well, today I want to talk to you a little bit about the Fed pivot. Now, if you have been watching for a while, if you're one of the handful of people that do watch this program, if you watched what I had presented back in December when so many people were jumping up and down, the Fed has pivoted, the Fed has pivoted, the Fed has pivoted. And I said, no, actually the Fed hasn't. The Fed hinted that they might, but the Fed didn't actually do it. So you know what they say about counting your chickens before they're hatched. That's kind of what we have there. Now, things are changing on our economic landscape, and we need to talk a little bit about the Fed pivot. All right, I have a page pulled up here because I was looking for a quote. This is from The Hill. This is a few months old in terms of we're just about out of April, and we're just about into May. So when we add early March to April being gone, that's about 2 months old, but I want to bring back this statement that Powell has said there will be bank failures caused by CRE losses. And I want to bring that to everyone's attention after I talk about everything else. So let's look at this right here. Today's news, the most current news, has been on the GDP. This is from the BEA, or Bureau of Economic Analysis, and I'm going to slide this up now that I have mentioned this. We're going to run this up to domestic product first quarter 2024 advanced estimates. There we have Q24 says that first quarter we are at 1.6. Right there it is, 1.6. And I just highlighted below that where we were at Q4, which was 3.4. Now, why do I bring that up? Because we'll go back and look at that chart, look at the big orange bars, the UT orange bars, but we're seeing that GDP is still positive, but it is diminishing somewhat. And that is an indicator that we are, in fact, finally slowing down the economy. That's part one. It appears that the economy is slowing down, but there's more than that to it. So let's go back to that. So when the Q3 came out and it was twice what they expected, I was one of the ones who were kind of suspecting some bovine scat right there, that it wasn't really that high, but it could also be that people were trying to buy before inflation bit them on the tuchus worse than it already has. Now we see it has come down in Q4, and now of course it's in Q1, it's down quite a bit, still there at 1.6. So that's still positive, that's still very good. It still shows that we are going very well. The question is, why is it that we keep our experts who are running our government on the finance side can't seem to get anything right? This was supposed to be much lower, this was supposed to be much higher, and yet it isn't. But I think if this is accurate data, it's showing a trend that perhaps Q2 might actually be much smaller. As long as it's positive, I don't expect much of a pivot then. And remember how resistant they are to call a quarter's negative GDP, to call that any kind of recession kind of stuff. They don't like to even say that word. When we had two in a row, they came back and fiddled the numbers and got it back up and said it's not really a recession. But it is what it is. If we were to believe the government and the BEA, we are dropping in productivity as far as a nation. Well, that's going to get us over here to a different page I have pulled up. And this one, I'll slide back down where we can see it. This is from the BLS, also government, the current employment statistics. I like to sometimes call it the situation because that's what the statistics really are. They're the situation we're in. Now, if we look at this in terms of 1 month change, where I had this pulled up, let me pull it up high so that I'm not interfering with any of it. You see pretty well much the employment is static all the way through all of these different areas: transportation and warehousing, utilities, information, financial activities, all this. And only up here when we get up, and it is a flagging chart, so it's very annoying, we have total non-farm says it's up, but look at that spread that it has on its expected accuracy. It's not very good if we really want to know the truth. And in total private is got a pretty wide range, not very confident with it. And it's only when we get down to goods producing, manufacturing, because we do have a lot of metrics there, is it a little bit tighter, but it's only slightly positive, and that's employment. Now, the service providing still remains very strong. But if you remember some of the past reports where we looked at the beige book and listened to what some of the districts were saying of the Fed, we see that most of the growth was in government. Not a good thing when government expands. We see also that it's in healthcare was another big one. So between government and healthcare and some in the service areas that we're seeing, if that's what's bringing all of our numbers up, those government employees are going to need government salaries, which are going to come from tax dollars, tax revenues, and that tends to mean that the government is going to raise taxes, which I didn't bring you the report, but Biden said this week that if he's elected, he's going to let the Trump tax cuts expire. And whether you agree with the tax cuts or think the orange man is bad or think he's a great guy, the bottom result is that's going to take even more money out of the economy that could keep it going, right? Could keep it going and give it to the government who's just going to spend it. So I don't see if that were to happen, that would be a good thing. It seems to me that most of us, including small businesses, even large businesses, need all the money they can get to keep things going, to keep people on the payroll, keep things above water. So I don't know that announcing that you're going to raise taxes is going to help. Now, I know in my mind, I think he's doing it because he thinks that people think those tax cuts only help the uber rich and didn't filter down to them in any shape, form, or fashion. And they're not going to result in even more inflation because companies don't pay taxes. They pass taxes on to the lowest man, the last man in the transaction pays the taxes. So if we cancel those on the money-making side, that's probably going to come back and get us. We're the ones who are going to have it. So let's look at another little statistic. We're going to call this the Economic Daily. We're going to pull this down. And guess who this is from? Again, the government, the U.S. Bureau of Labor Statistics. And we'll slide that back down to this chart. Let me get it pulled up high where we can get it, where we can see it. And what do we see going on here? This is all employees. When I do that, it makes a dark blue line. All employees' earnings are trending down as of our last available data. What about production and non-supervisory employee average hourly earnings? They are also down. So what does that portend to you if earnings are down and inflation is up? Is that a good combination? Are they working? Are those two trends working in our best interest? Now I want to return just momentarily, if you'll bear with me, back to the employment data. Here we have from the BLS, because I want to take it from the 1 month chart. I want to do the yearly chart and see if this pattern that we see where the supposed jobs are being put on have changed much. And what we see is in the last year, almost everything is staying fairly low as far as those jobs. And it's all on the non-farm. Good producings are still going to be just about flat. Then we have, let's see, what is this one right here? This is service providing. Total private is up. So where is this coming from? Where are these jobs coming from? We've already hit that. Nothing really has changed. So where is our economic power coming from? Well, let's get to something else since I talked about how wages are actually trending down. Earnings are trending down. Let's look at this one. This one is from the BEA, Personal Consumption Expenditure. This is the price index that the Fed looks at, not the one that we were talking about earlier. We don't look at the CPI, we look at the PCE. And what it says, if I can slide this on up toward the top, it says March is 2.7. This is changed from a year ago. This is year-over-year change is almost 3%. What's the Fed's target? 2%. Are we anywhere close to 2% at 2.7? It's better than 8 or 10. But 2.7 is actually increased over February, where January and February remain the same. And the December's change, when we had all of that GDP growth, we see it's actually just 0.1% down from there. So how does that help? Let's go to one more. Let's look at the CPI. Well, here's the CPI, and I have it already keyed up for a cute little graph down here. This is from the BLS, obviously, more government. And we'll slide this on up to this point right here. Now, this happens to be for our region of the nation. This is the South region, which Tennessee is part of. And you'll see that From 2021, we went from 3 all the way up here, just shy of 10%, as they had the CPI calculated. In 2023, was it, they redefined how the basket was weighted, how it was calculated, and we did see a drop in that. But since then, that recalculation didn't do much. It's just pretty well much kept it going sideways, except these last 2 numbers. You see, we went up for 2 months in a row. So what does that tell us that we're going to be doing based upon the Fed pivot? Now, as far as the pivot goes, we've heard them slowly but slowly start squelching the optimism that they're going to get 3 quarter-point drops this year. Now, we might see it in Q4, but it's unlikely that we're going to see it in the first part of Q4. And they're even talking amongst themselves, because inflation is reigniting, that they're going to have to focus on inflation and not worry so much about the cost of money, because we've got to slow things down. But with that said, if the GDP is dropping, that's a good indication we are seeing some level of slowing of the economy. So that might be good. We just have to see what the next quarter, Q2, pulls out. If it's still positive, I think my guess, just my guess, is that they'll push them even further toward the end of 2024. Hello, I'm Delbridge of Benchmark Realty, Murfreesboro, Tennessee. If you are currently unrepresented and would like to know how to compare up to 3 properties side by side and room by room, then go over to my new YouTube channel, CallDelToSell. That's 1 L and Del, no spaces. Watch the demo on Real Scout, and then call me and we'll set up your exclusive ad-free account today. There's really no reason to drop the rates if we're still running hot, if employment is still good, if inflation is the biggest bogeyman in the room. They're going to have to work on inflation. Now, what we don't want to see is inflation continue its pace up, to continue to accelerate and start ticking in job losses. That would be a bad case. High unemployment and high inflation is that old bad word, stagflation. So what do you think the pivot will be? We've just got it stuck since December of last year that the pivot will be a downward adjustment in the target rate. But we're starting to hear people mumble in the back of the class that we may only get 2 Fed cuts. If we get 2 cuts, some are saying 1 cut, which is, if it's 0.25%, it's not going to make a big difference. It's certainly not going to save CRE, which brings me to this major point. If Powell is expecting bank failures as a result of commercial real estate, then what do you think the investor class is going to do if we were to see a negative or a downward trending pivot on rates? If they take maybe a 0.5 point or full point off of the percentage, do you think they're going to stay with the very volatile CRE, commercial side, or will they start pivoting towards residential? My guess is it's certainly a possibility that if the rates come down, investors are going to jump over every opportunity they possibly can, because they're going to see it coming down. They're going to think the trend is going to continue. They're going to jump on those opportunities. And what is that going to do to the price of homes? Regardless of what inflation is doing, I think that increased competition will hold prices up, which is great if you're a seller. Not so much if you're a buyer. If you're a seller wanting to downsize, that might be a good trend for you to have that much more competition out there for your property. May increase the number of transactions. That may be very good for you. But if you're trying to buy and you're just trying to get off of the rent onto the housing ladder, that first rung, it may make it very tough for you. So remember, when we look at Fed pivots, how many people say it's a great thing, and if the rates come down, the rates coming down is not necessarily meaning things are good, because usually it means we're having a trouble in the labor market, significant trouble in the labor market, and investment companies will probably be in a better position to buy property than people will be, because it might be a little bit anxious for people worrying about, are they going to be able to hold on to that job? We just looked at the numbers for earnings. They're trending down a little bit. Will that trend continue? I don't know, but businesses are being squeezed. If we add in an election and an expiration of tax cuts that are just going to result in those higher taxes being passed on to us, that's going to add to inflation. And here's your problem that I see. The next Fed pivot, I think it'll be flat for quite a while, but I think the next Fed pivot may actually be to go up. not down, but up. We may see a reverse Fed pivot. To me, I think going down is a reverse, but if there is a bubble in the stock market, I'm not saying there is, but if there is, because it's only a handful of stocks that are bringing the big expansion, if they were to turn around, the stock market may actually take a hit. What are they going to do? What is the Fed's committee going to do? So that's all of that. I just would like to hear you comment. Do you think we're going to get numbers of cuts, 3, 2, 1, 0, or a reverse and put one back on? I would like to hear what you think. And it also helps the algorithms run this that look at this channel. If you'll interact with this channel, it will see more opportunities to expose to more people. So let's wrap this up, see what the numbers are. Okay, well, I probably went long on that middle segment. Wasn't trying to, but I'm just trying to connect multiple dots and multiple outcomes on the pivot. Going down may not be a great idea for a lot of people. It may actually be more headache than you get. And going up may not be good because that's going to raise the cost of borrowing money. And it's an indicator that inflation is getting out of hand. So we just need to watch a few things. So what does it really tell you? You've got two unknowns, both of which could be potentially difficult. It may be best to get started now. Last week, let's get our numbers. For 1924, we had 19,345 in the opportunities in the Real Scout system. Sign up for your account today. 4574 were the under contract still showing. That ratio remained the same at 24 over the previous period. 19,559 were today's opportunities. That is up again, a little bit of a trend up. We had 4657 in the under contract still showing, and that also trickled up a little bit. But now for the 5th week in a row, the ratio between those two is at 24%. So we're holding pretty solid in our area. So that's it for today's show. Remember to click like and subscribe. It's going to help. Throw a comment down there. You can even tell me that you think my gorgeous beard looks terrible. Whatever it takes, just have a little interaction. You're not going to scare me away. So let's talk. You can PM me. You can do a lot of other things. You can call me. There's a lot of information through this video that you know how to find me. Just get started. Appreciate you. See you next week.